Hello and welcome to Capital Link's Expert Talks webinar series, which features weekly interviews with leading executives from major shipping companies and other industry players. My name is Anthony Paizes. I'm a partner and the head of ship finance in the Greek office of international law firm Dickinson. I'm joined today by Stavros Gyftakis and Theodora Mitropetrou of NASDAQ-listed shipping company Seanergy Maritime Holdings. By way of introduction of our guests, Stavros has been involved in the banking and shipping sectors for over 18 years. He joined Seanergy in 2017 as its chief financial officer and has been instrumental in raising both debt and equity for Seanergy and refinancing the group's debt. Stavros also serves as CFO and director of spin-off company, the NASDAQ-listed United Maritime Corporation. Now, Theodora is the general counsel and corporate secretary of Seanergy since 2008. She also serves in the same capacity for United Maritime. Theodora is a board member of the Bahamas Ship Owners Association and has been recognized in the Legal 500 GC Power List as a leading practitioner. Welcome, Theodora and Stavros.
Hello.
The subject of our podcast is access to capital, and we'll be looking at how Seanergy has been able to raise capital from a wide variety of sources over the last few years. Well, before we get into that, Theodora, could you please tell us a little bit about Seanergy and its business?
Yeah, sure. Hello, Anthony, and thank you for having us at the Capital Link podcast. A little bit about Seanergy. Seanergy Maritime operates in the dry bulk sector, more specifically in the Capesize segment, and we specialize in transportation of commodities such as iron ore, coal, and bauxite. We currently own and operate 19 vessels, 18 Capesizes, and 1 Newcastlemax, with a total cargo carrying capacity of approximately 3.42 million deadweight tons. All of our vessels are chartered to the world's major miners, traders, operators, including big names such as Cargill, Glencore, Uniper, and all of our charters are index-linked time charters. These charters provide us with certainty because we have a fixed period, while we are allowed under our agreements for our earnings to be based on the market index. This enables the company to capitalize on a strong Capesize market. Under the leadership of our CEO, Stavros, our management team comprises of professionals with extensive experience in the shipping and the capital markets, which is what we think has driven our company to significant growth, especially in the recent years. Our strategy generally emphasizes maintaining a modern and efficient fleet, in optimizing operational performance, and leveraging market opportunities for growth through freight hedging and strategic acquisitions. At the same time, we are committed to rewarding our shareholders, as shown by our dividend and buyback actions, especially in the recent years. I would also like to say here that we are fully committed to sustainability. We have developed an ESG strategy, which is aligned with all the global reporting initiative standards and the Sustainability Accounting Standards Board guidelines, and which focus on reducing environmental impact and promoting social responsibility.
Wonderful. Thank you for that background, Theodora. I'd like to move on a little bit to the financing arrangements which Seanergy has been able to put in place. And I'd like to address the first question to Stavros here. Stavros, the shipping industry has traditionally been heavily reliant on bank debt as its main source of funding. However, due to increased regulation, banks are becoming increasingly more selective. And as a result, shipping companies are having to explore a variety of alternative funding sources. Some examples include public offerings, private placements, export credit, subordinated debt, sale and leaseback structures, and even crowdfunding platforms. Could you please tell us a little bit more about the sources of capital which Seanergy has been able to access to date?
Of course. Hello, Anthony, also from my side, and thanks to Dickinson and Capital Link for this initiative. Now, specifically to your question, both Seanergy and United, as listed companies, have the advantage of having access to both public equity and debt. By debt, I mean either traditional shipping loans or sale and leaseback transactions. Now, Seanergy in particular has tapped in the past both sources to finance either our capital needs or our growth, and depending on the prevailing conditions of the shipping, the capital, and the banking markets. Now, today, our financing strategy generally aims at maintaining a balanced capital structure, targeting mainly the sustainability of the business next to enhanced returns for our shareholders. Specifically for debt financing, following the market crash of 2016 and the withdrawal back then of many of the traditional players, we diversified our source of debt to include, other than traditional bank facilities, sale and leaseback agreements, mainly with Asian counterparties, and in some cases also some private credit funds. Currently, the mix is evenly split between traditional debt and sale and leasebacks, I would say, with lenders from both Europe and Asia. This approach has allowed us to build a solid, I would say, reputation across continents, and we have been able to attract interest from various financing institutions. Some of our sale and leaseback deals have been also very innovative, like the one that we concluded with Cargill in 2018, which included also scrubber financing and financing of energy-saving device installations, and these have been recognized for their unique characteristics. Now, in alignment with our ESG strategy, as Theodora mentioned before, we have recently, and by recently I mean the last 2-3 years, entered also into sustainability-linked loans, which represent currently a fair part of our debt portfolio. We have, I think, around 5 out of our 19 vessels being financed through these structures. And this signifies also our commitment to the industry's carbon emission reduction goals. Now, regarding equity offerings, we have in the past tapped the equity markets both through public registered direct and at the market offerings. Generally, I think that the optimal time to raise equity is when high return projects align with investor interest. And typically this happens at the start of a shipping cycle expansion. The last large offering that we did for Seanergy was back in 2021. The market backdrop was very positive back then, so we managed to raise around 75 million through a registered direct offering at a big premium to our NAV back then. Actually, I think that in the last 5 years, this may be the best priced shipping offering. Now, as we speak, we have a 30 million ATM in combination with a similar size buyback program in place, and we tap both programs opportunistically. We're looking to support the share price or lock an arbitrage on our shares, sort of buying shares low and selling them high kind of thing. I think that summarizes Seanergy's position right now.
Thank you. Thanks, Stavros. Just as a follow-up question from there, in the course of implementing Seanergy's growth strategy, do you have plans to raise further capital on the US capital markets? You mentioned that you have some ongoing projects at the moment for note buybacks.
Look, given our strong balance sheet right now and the good dry bulk market, I can't see us looking to raise equity, especially at a discount or NAV. Also, if you take into account that vessel values are relatively inflated right now, raising equity at a discount to buy vessels at a premium doesn't really make any sense. As I've told you last time that we raised equity, it was at a premium to NAV, and then we bought ships that appreciated in value shortly thereafter. So this made a lot of sense back then. Also, when you look at United, the little sister of Seanergy, so to say, we raised equity at a small discount when we first listed United. Although, discount for United was a relative concept back then because it was like a single vessel owning company and it owned only a 18-year-old Capesize vessel. So, a certain discount should be expected. But then we used the funds to buy discounted tankers, which we then sold at 2 times the acquisition prices. So there's no bad or good offering. It's what you do with the proceeds that matters and whether you are able to eventually create accretion for the shareholders.
Great, thank you. And I think that's right. What it comes down to is actually being able to offer shareholders a good return. If I understand what you're saying, that is the key to successfully raising equity.
Exactly. That in combination with a good overall business plan that shows that the company will be resilient, irrespective of how the market will develop. And also, it's important to have a credible governance structure for the shareholders in place.
Thank you, Stavros. Actually, I'd like to pick up a little bit on what you mentioned about the Asian sale and leaseback leasing houses. Japanese and Chinese lessors have since 2018 really coming quite powerfully into the market and made cheap financing available to the shipping industry. I'd like to ask whether to what extent Seanergy have been able to use these structures and how important they are to Seanergy's growth strategy.
Sure. Look, back in 2018, we did our first single vessel Capesize sale and leaseback with AVIC, a Chinese lessor. That proved to be a landmark transaction both for us and for AVIC. And since then, we developed very strong relationships with various Asian finance providers that can offer competitive financing solutions tailored to our needs. So over the past years, we have done business with CMBFL, Huarong Sinopac out of Taiwan, and selected Japanese owners. Now we have overall 10 vessels financed by these counterparties across Seanergy and United. Given the favorable terms that are offered by finance providers in Asia, along with their improving understanding, I would say, of the shipping industry, we are pretty confident that they will remain our long-term partners on the financing side.
Right, and 10 vessels, that's a substantial part of the Seanergy fleet.
Yeah, it's almost 30% of our fleet, considering Seanergy and United as a group, so to say.
Right, that's very interesting. One of the other forms of finance that you mentioned was ESG or green loans, and I'd like to ask Theodora to give us a bit of an idea of how much Seanergy has been able to utilize this form of lending and what the benefits of that type of lending are to Seanergy.
Yes, we have utilized this form of green financing, which have been very helpful and of course provides with our sustainability targets and aims. It is a form of financing that also enables the company to abide with the environmental regulations, coupled with providing the finance that we need from time to time for our vessels. So yes, and I think, and Stavros, and we can jump in, is something that we will most certainly continue to pursue, because on the one hand, we have vessels that are over 10 years of average age, so the 2050 regulations do not actually apply per se at this moment in time to our fleet, but green financing is a very good way to obtain financing and also abide with the environmental aspect and regulatory framework of it.
In terms of utilizing this form of finance, have you found that it assists also in raising other aspects? For example, the capital markets with the listing of the company. Does it sort of hold advanced appeal for investors? Perhaps the brand has increased prestige. Do you find it helps to attract new investors?
Very important for all stakeholders. I mean, be it shareholders of the company, investors, but generally, they are all very interested, in a company that has a green, let's say, strategy. And we, apart from that, we obviously put a lot of value in this, and we will continue to do so.
Right. So one of the sort of common headaches that you hear about with these type of facilities is the information that's required about the environmental impact of the vessels. How does Seanergy set about accurately measuring vessel efficiency and vessel performance, greenhouse gas emissions, these sort of things?
Well, it requires a lot of due diligence, let's say, and we continuously monitor our vessels, their environmental impact by using advanced performance systems that provide us with real-time data on fuel consumption, emissions, in order to ensure compliance with our commitments, sustainability commitments, and of course the regulatory framework that is in place. Because the systems are real-time data and they provide real-time data analytics, we can also efficiently assess the fleet performance against all the critical parameters that we need to. And of course, our commitment to sustainability is reinforced by our ISO certifications that, as we know, have very specific criteria for an effective environmental management system. We recognize, obviously, as many shipping companies, the importance of being regulatory compliant because it also mitigates a lot of potential legal risks, and it also reinforces our commitment to have responsible operations overall.
And with the deadline of the shipping industry to reach net zero emissions by 2050, is this form of lending is becoming more significant for Seanergy? And sort of connected to that, does Seanergy have any plans to invest in alternative fuel-capable vessels?
As we said just a bit earlier, the age of our fleet, the average age of our fleet is about 20 years, so it's not applicable per se in this moment in time. But as discussed by Stavros and myself, it is very important, and there are immediate benefits on pursuing, for example, green financing and being environmental, let's say, friendly. Longer term, the industry, the whole shipping industry will have to contend at some point with all the new environmental rules. So yeah, I mean, a company at some point in time will have to make a decision whether it will either invest in dual fuel capable vessels based on current existing designs, or whether it will invest in vessels with new propulsion systems. We at Seanergy, we always evaluate all the risks and benefits, but we think that, you know, longer term, we need to have more information before we actually commit to a specific plan in that sense.
At the moment, Seanergy are installing scrubber installations on the vessels, is that right?
Yes, we have installed scrubbers in many vessels of our fleet, which we were one of the first, if not the first, Stavros, of not 100% sure companies to have done so. It's quite interesting because I remember from my perspective when we, for example, negotiated the charter parties to include, because we did that as a co-investment with our charters when we negotiated the time charters that had to include clauses about scrubbers. No one in the industry knew how this should be put forward in a clause and provision in the charter party. So from my perspective, this was very, very interesting at the time. Yeah, so we have.
Great, thanks. Stavros, you wanted to add something to that?
No, I mean, Theodora covered me. I was mentioning these cooperative schemes with the charters that were unique in the industry back then. And of course, that came with a lot of legal hurdles for Theodora and the team in documenting everything and putting the right provisions in the chartering agreements. But, you know, Anthony, as long as the partnership is good and the relationship is good, I mean, anything that was not provided at the end in these agreements, we worked around it with the charters. So it was something that worked out quite well for us.
Great, yes. Thank you. I'd like to turn the conversation back quickly to traditional bank finance. Now, according to market data, 62% of finance is still to go into the shipping industry through traditional debt, through banks. That's down from 67%, and the trend generally is towards a decrease of that. Within that sort of context, what's remarkable is the growth of Asian and Australian banks, who currently have about 40% of the market share of the loans being made to the shipping industry. Has increased competition from Asia and Australia made bank finance more attractive for ship owners?
I think, yeah, indeed, Asian market share in ship lending has increased a lot, especially over the past 6 years. Also, when we view it as something that still has some more room to grow. In terms of background, I think this trend started off before the significant improvement in shipping markets took place in 2021, since back then Asian lenders were open for business during a difficult period while European lenders were restricted by the regulators post-Lehman, and they were significantly more risk-averse, let alone the massive withdrawals from the market of traditional shipping lenders that we were faced back then, like RBS, DVB, and most of the German banks. But following the recovery in the shipping markets, European lenders have returned. They're becoming more competitive in the terms, so the gap has now closed somewhat. Nowadays, we do have a wide range of options, and I think it all depends on the type of the vessel, the age of the vessel, the market that the vessel operates to choose the right product for your financing. For example, European banks can typically offer lower priced loans, but have steeper amortization profiles. Thus, they tend to be more competitive and suitable for younger ships. Sale and leasebacks out of China or Japan, on the other hand, are typically priced a bit higher, but offer higher leverage and longer profiles and more flexible structures overall, in terms that the covenants there are either less strict or in some cases even non-existent. But execution takes longer. So if we're looking to refinance, let's say, a mid-aged vessel while targeting also to free up liquidity to support the follow-on acquisition, then we would normally address this to a Japanese or a Chinese leasing market, because you have time and you can properly structure that and go through their approval processes. Now, if we're looking to finance quickly a prompt acquisition of a more modern ship, then we would typically address this to a European or a Greek bank.
Right. You touched on regulation. This is relevant more for European banks because of the Basel IV capital restrictions, which are due to come into effect next year in 2025. Some studies estimate that the borrowing costs in the EU will increase by around 25 basis points on the back of the additional capital needs. So with this in mind, are Seanergy considering further ties with Asian and Australian banks?
Look, I think that we have very strong ties already to the market, and we have a very decent reputation there. But I think like 25 basis points or 50 basis points in today's interest rate environment would not make or break the company. Yeah, for us, it's also a relationship game. I mean, we want to do business with the right people in the right side of the cycle. So yeah, Basel IV, okay, it will require banks to keep additional capital in reserve. This will reduce their ability to leverage the balance sheets. But still, I mean, if you have the right partner, we wouldn't jeopardize, we wouldn't risk the relationship, we would jeopardize the business model of the company just to save 25 or 50 basis points. If we have the right counterparty, we will continue working with them.
Thank you, Stavros. That's very interesting. I'd like to conclude this discussion by asking you and Theodora for your predictions over the next year. How do you see the ship finance landscape developing over the next year? And what financing options do you believe are likely to be most utilized by the shipping industry in this time?
I think I'll let Stavros answer that. I think he's not the appropriate person, and then of course you can make the remark.
Okay, Stavros, no pressure.
Ryan, please feel free to chip in. Look, I mean, we have discussed the market share that Asian lenders are getting from the European banks. At the same time, we have seen lately the European lenders loosening up a bit some of the restrictions. For example, the other day we received a term sheet from a European lender with a 20-year age profile for the ship that was 17 years, like 2-3 years ago. So we didn't expect to see such flexibility coming out of the European bank. So the competition among lenders will further intensify. And there's lower demand also for new loans, so they need to do something to keep up with the competition. Otherwise, longer term, and we were discussing that with Theodora recently, that longer term we will have to tap more of the sustainability and green loans, taking into account the financial and operational and legal risks that are associated with the energy transition of our industry and the required investments in new technologies.
Great. Thank you very much indeed, Stavros and Theodora, for your insights. I think that's pretty much all we have time for. I'm going to say thank you very much to both of you, and goodbye to everyone.
Thank you very much, Antonio. Thanks.
Thank you.
It was a great discussion. Thank you.